I'm going to talk through a conceptual model to help us understand how the primary financial statements fit together in a dynamic forecast model. And the starting point is something called the accounting equation. The accounting equation states that assets, being what I own, less liabilities, being what I owe, are equal to equity. I'm going to work with a temporary definition of equity for now, being what's left over after everyone else has had their share. And we can play with some numbers here to demonstrate. Assets of 200 and liabilities of 160 mean that only 40 is left over, so equity is equal to 40. The accounting equation forms the basis of a balance sheet. In this simple balance sheet, I have rearranged the equation so that assets equal liabilities plus equity. And if I put some numbers in, you can see it is pretty much the same as when we started with my original equation. Assets of 200 is matched with liabilities of 160 and equity of 40. In this second balance sheet, I've begun to split my assets out to show, critically, retained cash. Retained cash is the cash collected and stored short-term by a business, for example in its bank accounts, and it is a key asset of the business. Likewise, you'll note that I have split my equity into two. Share capital represents share certificates issued by the business to the equity investors, and which carry a face value. Retained earnings represent profits collected and stored by a business. Unlike retained cash, retained earnings have no physical form, but they are a representation of what might be given to equity investors if the business ceased trading and everything was sold off for cash. For now, it is enough for us to note that it is our ambition to convert all profits that we generate into cash as quickly as we can. And as you work through this course, you will begin to understand why profits do not immediately turn into cash, and how the modeler should best model those timing delays. Now that we have a balance sheet, let's put in some workings to support both retained cash and retained earnings. For balances, we will need to answer the key questions: what makes the balance go up and what makes the balance go down? But for now, I'm content to have a corkscrew supporting each of my balances. And I am working, for the purposes of this conceptual model, with a 4-line corkscrew. In other words, one that admits no possibility of an initial balance. Let's link the closing balance into our balance sheet for both retained cash and retained earnings. I'm also going to use the acronym BS for balance sheet as an extra clue to tell me that this calculated number is being fed through, is being linked through to a balance sheet. Now let's answer the question, what makes retained cash go up? And the answer is cash flow coming into the business after everyone else has been paid. And that's because in the context of equity, everyone else needs to be paid before equity investors have a claim on what's left over. And let's be clear who everyone else is. It's employees, suppliers, debt investors, and tax authorities. Equity investors are right at the bottom of the pecking order. Using corporate finance language, I would describe equity investors as having a claim on cash flow that is post-finance and post-tax. And I have set up a simple cash flow that illustrates this point. Cash flow available for equity is after deducting from revenue, operating costs, debt finance costs, debt principal repayments, and tax paid. And exactly the same post-finance, post-tax philosophy applies to profits that belong to equity. Equity investors have a claim on post-finance and post-tax profits. So here I have a simple income statement that starts with revenue and deducts costs, debt financing costs, which would be things like fees and interest, and a tax expense. Both my cash flow available for equity and my profit after tax can be linked into my corkscrews. That's what makes my retained cash and my retained earnings corkscrews go up. And if I chart the end balance on each corkscrew, you will see that retained earnings and retained cash are both accumulating throughout the forecast period. A key question for equity investors is going to be, how much cash can we extract from the business, and how quickly can we do it? When I come to convert this conceptual model into a spreadsheet solution that complies with FAST, I need to think carefully about my use of worksheets. And here's my plan. I plan to have a separate worksheet called Equity that will hold my two corkscrews, one for retained cash, one for retained earnings. I plan to have another worksheet called FinStat, where I will put my three financial statements. And just a reminder, you will see on the FinStat sheet the balance sheet containing my retained cash and retained earnings balances, the cash flow statement that answers the question, what makes retained cash go up? And finally, the income statement that answers the question, what makes retained earnings go up?